There are so many trading strategies out there, and honestly, it can feel very overwhelming. After countless hours of studying, I finally started using this one candle strategy that helped turn my trading around from red to green. In this video, I'm going to be sharing why you should use this strategy, how you can use this strategy, and I will also be sharing a cheat sheet to help you execute your trades every day. First things first, I'm going to go over why you should use this strategy. Number one, no bias. You can come into the market without having a strong bias where, oh, I'm bullish or I'm looking for bearish trades and trying to short the market. You don't have a bias. You're open-minded. Number two, it's beginner friendly. This strategy is easy to understand and follow. And if you're in a drawdown, it can pull you out of a drawdown. It personally got me out of a drawdown. That's why I'm preaching this strategy. Number three, yes, it works on different asset classes, the forex market, futures, crypto, and stocks. In this video, I'm going to be explaining briefly why this strategy works, how to trade the strategy to increase your win rate. And at the end of the video, I will give you a bonus cheat sheet so that you can have this by your side while you trade until you get used to all the scenarios. Step number one, you want to mark out your key levels. And in this case, because you're coming in without bias, you just want to mark out your previous day's high and your previous day's low. The reason for this is because when price breaks above your previous day's high, remember, what is a trend? You want to see like a staircase effect, right? For an uptrend where it's making higher highs, higher lows, higher highs, and higher lows. If price breaks above your previous day's high, it means that there's a chance that we will continue to go higher. But if price breaks below the previous day's low, there's a chance that you continue to go lower and you can trade down to the next level or next target. That's why this strategy works, because it's built upon just continuation, trading with the trend. So once you've marked these levels out on your daily time frame, mind you, you're doing this on your daily time frame. You're not marking pre-market or post-market hours. This is very important. You want to turn off extended hours when you market. In fact, if you're doing it on a daily time frame, you shouldn't even see the extended trading hours on it. I trade the New York session, so that's also important for you to know. Step number two, you wait for direction. Like I said, when price breaks above the previous day's high, there's a high chance that we will see continuation towards the upside. And in this case, we're on the 5-minute right now. We are waiting for the first 5-minute candle to develop and to see if we get a strong candle close above this previous day's high level, which we did. You don't want to see a strong wick to show that maybe sellers were stepping in to push price lower. You want to see some of the strongest bullish candles, a good decent close with displacement above the level. Now you switch to the 1-minute time frame. You're not doing anything yet at this point. You are just observing. You're observing and you're waiting for a pullback. Waiting for a pullback into the previous day high level, and you're watching to see if buyers will step in at that level and try and close above the previous day's high. At this point, yes, this bar has signaled to us that sellers are trying to push the price lower, but buyers are stepping up. So you're alert, and this is your signal bar. Now, you see that at this point here, buyers have fully stepped in, successfully closed, although this candle looks small, but it's closed above this previous bar's high, and it's showing that yes, okay, buyers are stepping in. The next 1-minute candle develops, and you can now enter your trade once we break above this candle's high, and your stop loss would be a break below this signal bar's low, and then you can target a 1:2 risk to reward. If you followed every single step I've mentioned previously, you should be able to get at least a 1:2 risk to reward, and this strategy has above the 70% win rate, so you would most likely be profitable as long as you are sticking to your rules. As you can see, you're risking, for example, $100 here to make $200. I'm going to quickly go over a bearish example next. For a bearish case, you want the previous days, for a bearish case, you want price to close strongly below the previous day's low. And again, same step, wait for this close to happen on the 5-minute time frame. And then you switch to the 1-minute time frame and you look for an entry. The thing is, when the market is selling off, it might not give you a clean confirmation candle, because like we all know, right? We take time to go up. It's like staircase to go up. But anytime the market sells, it sells really fast. So moves to the downside are usually aggressive, and you typically want to stay alert and not miss that entry, because sometimes you could miss it if you're not alert. So same thing, the candle closes, you wait for a pullback, you see rejection of that level, you see a bearish candle that engulfs this rejection candle here, right? To show that sellers are present, and then you take the trade towards the downside. I promise that at the end of this video, I'm going to review a cheat sheet to show you how to trade different scenarios. So here's the cheat sheet. For scenario 1, which I covered in this video, is a break. Once you see a break above the previous day's high, you want to focus on long setups. By longs, I mean bullish setups, trades to the upside. And then you target next resistance level that you have above, or your 1:2 risk to reward. For scenario 2, if price breaks below the previous day's high, you can focus on shorts, because if price again has broken below the previous day's high, it means that there was lack of continuation in the trend. There's a chance that we could then trade lower to the next support level or previous day's low, which will be below. Or you can then target a 1:2 risk to reward. The goal is not to catch 100% move or a large move. It's just to get a little piece of the move and go on with your day. And as you increase your win rate and you perform well and your account grows, you can then size up. But we don't get greedy. You just want to catch a little bit of the move. Scenario 3 is if price bounces at previous day's low and you see confirmation of buyers stepping in, right? I've shown you how to enter trades. I've shown you the good entries. You use those theories to enter the trades. So if price bounces at the previous day's low, you focus on long setups to your upper target or previous day's high, or you can again just use the baseline of 1:2 risk to reward. Scenario 4 is the bearish case I just covered. If price breaks below the previous day's low, you want to focus on shorts down to your lower target or 1-2R. If you're just starting out and you're learning how to trade, I recommend you just focus on scenarios 1 and scenarios 4. If you're well advanced and you know how to trade reversals as well, then you want to add on scenarios 2 and scenarios 3. That's it for this video. Thank you for watching to this point. I'll see you on the next one.